Okay, so today we're going to be looking at the first chapter in our textbook. We're going to be looking here at chapter 1. It's very difficult for me to overstate the importance of chapter 1. As we go through this, you may believe that this is not that important, that this is just a lot of boring terminology that you really aren't interested in, and that is fair. I understand that feeling. The issue is if you don't have a solid understanding of the concepts here in chapter 1, then everything we do after chapter 1 for the remainder of the semester becomes much more difficult. So we want to make sure we spend the time that we need really digging into chapter 1, understanding all these different concepts and terms that you may not be familiar with because you may have never seen anything about accounting before. And so this is going to give us that opportunity to really figure these things out. So as we dive in here to chapter 1, the first thing we want to look at is just figuring out, well, what is accounting? Why is it important? How does it matter to me? All of those types of things. I think if we can figure that out, it's going to help us find this to be a little bit more interesting. So the idea with accounting is we're trying to do 3 things. We want to identify transactions. We want to record those transactions, typically in some type of a journal. And then we will communicate those activities both to our investors, to the external public at large, to our internal users of that information. All of those people will primarily be analyzing the success of our business by looking at our general purpose financial statements. So one of the main focuses in this entire course is going to be in this last section here of communicating and figuring out how we actually prepare these financial statements, what information is contained on each, and so on. So we see down here at the bottom of this slide just a general statement about kind of what accounting is, pulling these 3 ideas together. So we'll go through that very quickly then. This simply tells us that accounting is an information measurement system that identifies, records, and communicates the organization's business activities. And that is it. That is all we are trying to do here. So if we can do those 3 things, we are looking at something regarding accounting. Now, the next thing we want to look at are the different users of the accounting information. So you may have heard it said that accounting is the language of business, and that is because all of the people below are using this information. Now the question is, do we have what is called an external user or an internal user? So the first thing we want to look at is identifying between these 2 things. So we see external users include people like lenders, so maybe the bank, your external auditors, right? It's right there in the name. They are external to the organization. It is critical that they be because they are the ones coming in at the end of the year telling us if everything was done appropriately. So if they are not external to the organization, they may have a vested interest in one outcome over another, and we don't want that. We want them to be entirely independent so that when they issue that opinion on the fairness of those financial statements, we can trust them. They don't have any vested interest. We would see that our external users are also the shareholders. This may be surprising to you because you may think, well, aren't the shareholders the owners of the organization? Doesn't that make them internal? And it's a fair point, but the idea here is your shareholders are not the ones making day-to-day decisions within the organization. So they are getting the same information by and large as the bank is getting because they're just getting these general purpose financial statements. The board of directors is the same thing. Of course, they do run the company at an extremely high level, but because they are not the ones making the day-to-day decisions, they are not considered internal for what we need. And finally, regulators. So any government regulators, government agencies, anything like that are, of course, external. Now, internal users, I think you'll notice a common trend here. You see research and development managers, purchasing managers, HR managers, right? So when we're talking internal, we are primarily dealing with the internal managers that make the company run on a day-to-day basis. That is who we are concerned about. Now, because this is your first accounting course, we do need to briefly, and I do mean very briefly, cover different things you can do with an accounting degree. So, of course, there are many different areas. The 4 main areas here are what we call financial, managerial, taxation, and related. So financial, you're either preparing financial statements, analyzing them, doing external auditing, regulatory, consulting work, anything like that. One of the things here is that last point, which is actually criminal investigation. And the last that I heard, the FBI is actually hiring more accountants than what you would generally think of as like a field agent, because the way that you find people is by following the money. So if you're interested in anything like that, accounting may be a really good route to go, because there is a lot of opportunity in some of those criminal investigation organizations. You then got managerial accounting, which is more of your day-to-day accounting within organizations. This will be the focus of your second accounting class, Accounting 2302, while financial will be the focus of this accounting course, Accounting 2301. In 2302, we'll look at general accounting, we'll look at cost accounting, budgeting, internal auditing, consulting. We'll look at all of these types of things. Further down the line, you'll actually deal with taxation. So when we talk about taxation, we're looking at how we prepare tax returns, not just for individuals, but also for organizations. So not just your basic 1040, but we might actually look at things like an 1120 and 1120S, all of those types of things and many others. You'll look at regulatory items, investigations, you'll look at consulting and law enforcement, legal services, estate planning, and then of course, accounting related. All of your banks need accountants, all of your businesses need accountants. So you'll see things like lenders, consultants, analysts, traders, directors, underwriters, planners, and appraisers, and on and on and on and on and on, right? There are so many different things you can do with an accounting degree. If any of these interest you, if you have any questions about them, I will try to help you kind of understand them in any way that I can. Just about me very briefly, I did do some tax work for a couple of years as a student, and then for a little while full-time after graduation before I moved into auditing for a little while, and then eventually I landed here teaching. So I do have a little bit of experience in both the taxation and auditing areas, although not a tremendous amount. But if you do have any questions, I'd be more than happy to discuss those with you. The idea here essentially is, while you may not have realized that all these places are using accounting, while you may not have realized that accounting is this invasive, accounting really does touch every area of our lives and every area of our businesses and organizations. So we do want to make sure we understand it. As you move into more of your supervisory and managerial roles within your organization, you're going to be faced with a lot more accounting related issues. And unless you have a solid basis in this stuff, it's going to be very difficult to make informed decisions. So we want to make sure we take this course very seriously and we really understand the roots of what this course is trying to teach us. So here we see this is, of course, going to be dealing with accounting when we earn money, pay taxes, invest savings, budget earnings, and plan. Of course, all of these things are things we can do with accounting. So the next thing we want to discuss here is really brief as to why ethics might be important. So let me ask you, okay, just as kind of a hypothetical, would you trust an accountant if you knew they were not ethical? Okay, so if you knew they were going to lie, cheat, and steal to do whatever they had to get the results you wanted, would you want to work with that person? I sincerely hope you said no. And I sincerely hope that you would not be willing to do those things. So the idea is we need to have very ethical accountants, because the accounting industry impacts so much of our economy that if we have unethical accountants, it can lead to disastrous outcomes. The most famous of these arose in the early 2000s when we looked at the fall of both Enron and WorldCom, as well as Arthur Andersen, who was their external auditor. In this case, Arthur Andersen was not truly external. They were doing side deals with these companies, and they were cutting deals with each other and trying to figure out ways to fudge the information. Well, eventually, all this caught up with them, and three of the largest companies in the world at the time, at least in the country, came down in just a matter of months, causing thousands of people to lose retirement, causing thousands of people to lose their jobs and lose their careers. And it was a horrible ordeal that could have been avoided if we'd simply had strong ethics at these organizations. And this is not to say that each individual at these organizations was unethical. Sadly, it may have only been a handful that caused this horrible event to unfold. So now we want to really make sure that we understand how we can look at ethical decisions and make sure we're making the best one. So there's essentially a three-step process when you're presented with an ethical dilemma. And we'll look at some of these as we go throughout the semester, different things that may come up that we may say, well, how do we feel about this? You know, could this be the right answer? And we may even realize that it's not always so black and white. I think when I first thought about ethics, when I was a student, I thought, okay, well, you either do the right thing or you don't. It's pretty easy to tell. Well, the truth is sometimes in business, it's a little bit more murky. It's a little bit harder to distinguish than you may first think. And so we'll try to look at some of these areas and see throughout the semester if we can find anything where we may not be able to make a clear-cut decision, or maybe we can. But we'll look at those things as we go throughout the semester. So the three-step process we're going to employ anytime we're presented with one of these ethical dilemmas is we first need to identify the ethical concern. So what is the issue here? Okay, so we'll talk about this more in chapter 2, but for now, let me ask you, okay, if you were working at my company and I came to you and I said, look, here's the deal. If we make our numbers this month, then we all get a bonus. Right? We all get this big end of year bonus at the end of December, and everyone's happy. But to do that, I'm going to need you to back this sale up a few days and put it in this year, even though it's not really getting made until next year. But we want this bonus, right? We all want this bonus right now. Okay, so there's your dilemma. Okay, you don't know why that's a problem in terms of accounting yet, but you know that doesn't really sound right. Why am I being asked to record a sale now if it's not happening until later? Right? You say that may not be the best thing to do. So there's our ethical concern. So what options do you have here? Well, one option is you subordinate your judgment. You say, okay, well, he's my boss. He knows apparently more than I do. It must be okay. So I'm going to go ahead and do this because I want the bonus, right? Everyone wants the bonus. And if they don't get it, they're going to know it's because I wasn't willing to play ball, right? That's one option. The other option is the perhaps a better option, which is to say no, right? Even though it means I'm not getting the bonus, even though everyone may be kind of upset with me in the office, this is the correct decision because the accounting rules that we'll discuss more in depth in chapter 2 and even a little bit in this chapter are going to tell us we cannot recognize a sale until it is completed, right? Until we've earned that revenue. And in this case, we will not have earned it until the next year. So therefore, I cannot book that revenue in the current period. So we see that coming through. So in the last step here is to, of course, make the ethical decision. So this is where I'm going to go to my boss, hopefully, and say, unfortunately, I am unable to do this for you because it is simply not the correct procedure to do. All right, so I'm going to stand by my ethics, refuse to subordinate my judgment, and if that means I lose my job, then maybe that just is what that means. But I cannot be going along with this type of behavior. Now, this is especially true if you are a certified public accountant because you can actually lose your license for doing this type of thing. And if this is serious enough, you could end up going to jail, paying hefty fines and penalties, and spending quite a few years in federal prison. So lots of issues here if you start making poor accounting decisions. And now I do want you to be a little bit cautious, and I do want to kind of bring your attention to something. This is not me saying if you make a mistake in accounting, you're going to prison, right? That is not what I'm saying at all. What I am saying is, yes, mistakes get made. But if you are intentionally making the wrong decisions, if you are intentionally changing your financial statements for some type of gain, that is fraud, and that will result in you going to prison. So what we want to look for when we're trying to determine, do we have fraud here? What do we think? Could this be a fraudulent situation? There are three main things that tell us there's the high likelihood that fraud could be occurring. So this is what we refer to as the fraud triangle. There's some excellent videos out there on YouTube that also go through this. I do believe you should have one linked up in D2L. If you don't see that, please let me know. I'll be sure to post that for you. But what we see here is if we see these three things coming together, we really want to slow down and look and see if we have some fraud occurring. The first of these that we're going to talk about is opportunity. So opportunity is essentially how. How can I commit the fraud? That is the question. So if I am working at a gas station, say I'm running the cash register, okay? So that's my job. I'm running the cash register at a gas station, and there's no controls over the cash register, okay? I work the cash register from the moment I walk in to the moment I leave. I never balance my cash register. No one ever checks to make sure I've given out the right amount of change or that I've collected the right amount of cash, anything like that. There are no cameras. There is no supervision, right? The absolute worst set of internal controls you can possibly imagine, okay? This is a situation that is ripe with opportunity for someone to commit fraud. There are no controls in place to stop them. So it would take a very morally sound person to not be stealing from me if I knew there was absolutely no way I was ever going to get caught, right? You could see how that could be very incentivizing, or very much an incentive to actually commit this type of fraud and just take the cash right out of the register, because I know no one's ever going to find it because there are no internal controls in place. So there's opportunity, right? So how could we commit the fraud? Now, the next side of this is perhaps financial pressure. So I'm going to kind of run this counterclockwise because I think it makes more sense in that order. So the next thing is financial pressure. So I've got the opportunity, but if I'm well off, if I don't need the money, I may not even decide to steal this, right? I know I could get away with it. The opportunity is certainly there, but I don't have any needs, really. Everything I need is I've got, everything I want I have. There's no incentive for me to steal this. So if that is not the case, though, right? What if I'm having trouble making rent? What if I've got medical bills? What if I've got student loan debt? What if there are other things coming into play? What if my family needs some money, right? What if I've got children and I'm struggling to put food on the table? What if there are these financial pressures? So now you see you've got this financial pressure, right? You've got these bills that you are unable to pay, and you've got this really lax internal control system that provides you the perfect opportunity to steal this and get away with it. Can you start to see how this is building into a situation where fraud is extremely likely? Now, the last piece of this is where we deal with rationalization. Now, once again, I want to ask you a question. If you commit the perfect fraud, right, you steal this money and no one ever finds out about it, I think someone still knows that you've done this. Okay, and who is that? So who do you think will still know that you have committed the fraud, even if you've committed the perfect fraud and you never get caught? Well, the answer is you, right? You know what you've done is wrong. You know you've stolen that money. You know that you have done something wrong. So the question is, when you wake up in the morning, every day, for the rest of your life, are you going to be able to look yourself in the mirror with a clear conscience and feel okay about what you've done? Or is that going to start to eat away at you? Is that going to start to gnaw at you? How are you going to feel about that? So we've got this idea of rationalization, and this is the problem here. So if you are able to rationalize your actions, right? You say, well, we used to get paid overtime and now they put us on salary, so we're not making as much, but we're working just as much or more. They owe me this money, right? You may not feel bad about it. What if you say, well, we're underpaid anyway? Well, you may not feel bad about it. What if you say, well, the people at the top are holding all the money for themselves. They owe us this money, right? There may be ways for you to rationalize this out where you say, what I'm doing is fine. It's not wrong. It's okay. And if you can do that, paired with the pressure, right? The incentive to actually steal because you have something you need, and the opportunity being extremely high that there are no internal controls in place, this is the perfect opportunity for someone to commit fraud when these three things line up. Now, if you're the company, which of these three can we most easily deal with to commit or to reduce the opportunity, to reduce the ability of somebody to actually commit this type of fraud? In this case, stealing the money straight out of the cash register. Okay, so which of these three areas do you think would be the easiest for the company to reduce? So I'll take the most common incorrect answer first. So the most common thing I'll hear is people make the argument that, well, the company can reduce the financial pressure on their employees by simply paying them more. And that's a fair point. And to some extent, that may be true. But the problem is, if the company pays their employees too much, we may not be able to remain in business, and then everyone loses their job. Or if I want to pay you more, I may have to hire less people, which may mean people either lose their job or don't get a job to begin with. So in certain industries especially, the profit margins are very, very small. any major increase to cost in any area, be it materials or labor or overhead or anything, will drive the company toward bankruptcy. So while in some industries we may be able to boost our wages of our employees some and help to alleviate a portion of that financial pressure, that may not always be an option. So the correct answer here, the one that we want to focus on the most, is this area of opportunity. If we focus on this area of opportunity, what we can see is that by instituting what are called internal controls, I can actually make it more difficult for you to commit the fraud. So this will do what I say as keeping the honest people honest. Okay. If you are determined to commit fraud, you will find a way, right? People break into banks, people break into secure areas all the time, right? There was essentially no opportunity in some of these areas that had incredibly tight internal controls, but somebody found a way to exploit them, okay? That is possible. So we cannot eliminate the opportunity completely, but I can do things that make you think twice before you start off on this path. So go back to our example earlier. No one was reconciling my cash register at the end of my shift. Now maybe someone else does. Someone else comes in and balances my drawer. So I have my employee first balance their drawer and see if they're off. Then I come in behind them at the end of their shift and I balance their drawer. Hopefully those numbers match and hopefully we don't have a difference. Right? That is one very strong internal control for this type of area. Maybe I put cameras over the cash registers, watching my employees, making sure they're not taking that extra change and putting it in their pocket, making sure they're not pulling money straight out of the cash register, making sure things are in line. Maybe I come in and I look and I say, okay, we've got this situation, and I decide that at the end of every shift, you're going to lock your cash register in the closet, right? You're going to pull out your drawer and lock it up in a secure location. When the next person starts their shift, they'll go get their drawer and bring it out to use so that I know if that drawer of yours is ever off, you were the one responsible for that being off. And there's no ambiguity as to who is responsible, right? And so we can do things to help to cut back on this. And when we think about internal controls, they go beyond this and they hit everything. Have you ever wondered why things are password protected? Why there are locks on certain doors? These are all different types of internal controls. And these are going to help reduce the opportunity for our employees or for the general public to commit fraud. Now, we talked about ethics, we talked about the fraud triangle. Now we need to talk about kind of the culmination of all of this area, which is SOX, or Sarbanes-Oxley. So Sarbanes-Oxley was passed in the early 2000s as a response to the Enron, WorldCom, and Arthur Andersen crisis. When all three of these companies collapsed literally over a period of a couple of months, right, of for sure less than a year, but certainly less than a year, Congress had to step in. So up until that point, Congress had pretty much said the accountants are always preaching to everyone on ethics, so we're going to trust the accountants to be ethical. Well, it turns out if you don't have some level of oversight, people tend to get lax in their ethics at a certain point. So Congress stepped in and passed this act. Now, notice this primarily deals with public company stock, but some private companies look to this act for guidance on how to structure their organizations. So while this only applies with the penalty of law to your public companies, some private companies will look to this once again for some guidance as to how we might want to handle certain things. Now, a couple of the main things here that SOX does, all right? So the main topics you really want to be aware of, number one, is that SOX requires documentation and verification of internal controls and the effectiveness of those internal controls. So prior to this, your management did not have to sign off saying, yes, we've got effective internal controls in place, they're working as intended, et cetera, right? We essentially didn't check on that. So now what's happened is SOX requires your CEO, your CFO, for example, to actually sign a statement under penalty of perjury and under penalty of law saying, yes, we have good effective internal controls, things are working as intended. Now, this also means that when your auditors come in at the end of the year, your auditors are going to have to actually verify these statements. So the way this looks in practice is whenever you're actually looking at an audit for a public company, there will be memos to the file on all of their different internal control policies. So when you look at a huge public company, say like Walmart, right? If you were to get a hold of their audit report, what you would probably find are hundreds, if not thousands, of pages of documentation detailing exactly how each internal control of that company works from the ground up. Even for some of the smaller private companies that I worked on when I was in auditing, we had many, many pages of detailed statements regarding their internal controls, from things like when do they come in, what order do procedures get done in, all of those types of things, because we need to know exactly how this is working. So we'll come in, we'll follow somebody through an entire process, see that everything is signed and verified and dotted and checked, and that everything ties together. And then we'll re-perform some of their things that we weren't there for and make sure that those things still happen. This allows us to verify their internal controls are not only working when we're standing there over their shoulder, right, where they're definitely going to do what they're supposed to, but also when no one is watching. And so that is the goal, is to make sure that these internal controls are not only designed well, right? Not only written up in some book that no one ever looks at, they use for a door opener, right? That's not what we want. We do want well-designed internal controls, but we need them implemented and we need them functioning effectively. Now, if the company, if your CEO or CFO signs off on this and knowing that their internal controls are deficient, then they will likely end up with criminal penalties involving both fines and jail or prison time. So that is certainly a good incentive not to lie about this. These can be very, very large and lead to very long prison sentences. Now, after we got SOX, about a decade later, we got the Dodd-Frank Wall Street Reform and Consumer Protection Act, right? For the sake of our sanity, I'll simply be referring to this as Dodd-Frank so that we don't have to read that entire name every time. So when we look at Dodd-Frank, it's essentially got two main areas that we want to be concerned with. Now, this is a very long act, right? It includes a lot of other things as well. So if you know more about it, that's fantastic. What I need you to know in this course is these two things. The first is what we call a clawback provision. So if your CEO or CFO went in, fraudulently altered their financial statements, made some changes, and they got a bonus because of that, then that excessive pay that they received, once the fraud is recovered or uncovered, will have to be paid back to the company. So it's a clawback provision. Okay, so mandates recovery of any excessive pay. And the second piece of this is that whistleblower provisions, which provide whistleblower protection, which is the main thing that you'll hear about in the news, is these whistleblower rules, right? This is what this does. It prevents you from being fired simply because you blow the whistle on your organization. Now, this is a little murky because if people know you're the one that blew the whistle and created, this massive, say, maelstrom of fire coming down on your company, well, people may not really like you. But remember, you're not the one that did the unethical activity. You simply said this is not what should be happening. So you're not in the wrong here, right? If you're the whistleblower and you blew the whistle because you saw something actually happening that was incorrect by the book, then you can be secure in knowing they cannot fire you because of that. Now, the other side of this, the SEC has agreed to pay whistleblowers between 10 and 30% of any sanctions exceeding $1 million. So, for example, if you work for a very large multinational organization and you blow the whistle on some incredibly fraudulent activity that you have found, and they levy penalties of $10 million on that organization, you will receive anywhere from $1 to $3 million from the SEC, right? So you will receive this payment for this piece of the sanctions exceeding $1 million. So 10 million, right? So minus the million is 900,000 times 10%. I'm sorry, 10 million minus a million is 9 million times the 10% is 900,000, all the way up to 2.7 million. So you can see how this math works. You can see how the range is there. Now, of course, sometimes these sanctions are incredibly large, far larger than $10 million, so you can end up making a tremendous amount of money. There are many famous whistleblowers who go on to write books and go, on interviews and do all sorts of things like that. So it can certainly be profitable to you as an individual, but it can also be good to restore the public's faith in the organizations that are supposedly working for our best interest and giving us the straight information. So we want to make sure we understand that. Now, the next thing we want to talk about is one of the main topics in this course, which is called GAAP, so Generally Accepted Accounting Principles. GAAP has essentially three things. We want relevant information. So if Walmart misplaces a $5 bill, okay, Walmart is a multi-billion-dollar a year industry. They lose $5. As an investor, do you necessarily care that Walmart has $5 less? So let's just say, making up for a number, okay, I haven't looked at their financial statements recently, but let's say they have $1 billion in cash. They lose $5. They've now got $999 million and some change, right? Do you care that they lost $5? Because I probably don't, right? As just a matter of fact, the $5 I almost couldn't care less about. Now, what I might be concerned about is if that loss of $5 is indicative of an internal control issue. So I say, okay, well, why did you lose the $5, right? And if that is something I'm concerned about, that's an entirely different issue. But the actual dollar amount of that loss, I'm probably not concerned about, right? Just as a general outsider perspective, I'm probably not going to be super concerned with the fact that I've lost $5. So we want to keep in mind that. So we're looking here at US GAAP, okay? And that's going to be the focus of this course. If you're taking this course in another country, right? If you're taking this somewhere in Europe or something, then you may be seeing what we call IFRS, which is International Financial Reporting Standards. That will not be the focus of this class. Everything we do in here will be driven by US GAAP. So the first thing is we want relevant information. Now, I'm probably not even going to put in the notes to my financial statements or anywhere that Walmart lost $5. Next, we want reliable information. So we want information that can be trusted. And finally, we want comparable information. So I want year over year to be able to be compared, not just within my organization, so not just as Walmart, but maybe I want to be able to compare Walmart and Sam's and Kroger, right? All of these different industries or all of these different companies within the same industry should hopefully have similar reporting standards so that if I want to go invest in a grocery store chain, right, then I can. Okay, now, I'm honestly not sure if Kroger is public or not, but the idea is the same. So the next thing is what we call international standards, which I hinted at just a second ago. So we have the IASB, the International Accounting Standards Board, who promulgates the IFRS, or the International Financial Reporting Standards. So that is the way this works. Now, if we flip back very briefly, right, financial accounting that we talk about in the United States is dealt with by the FASB, the Financial Accounting Standards Board in the US. But notice it is the IASB, or the International Accounting Standards Board, for the global people, for the other countries within the world. Now, what we then see is we have to look at what is called the Conceptual Framework. So I'm not going to spend a ton of time here. If you're an accounting major, you'll see this in about a dozen other courses. And if you're not an accounting major, then you'll see it here, and that'll probably be enough. So what they're trying to do, they meaning the FASB and the IASB, so the US and the international people, right? They're working together to try to converge the conceptual framework. So this is what I call, they're trying to close the gap, right? They're trying to bring these two areas together. Now, this has been going on for many decades now, at least 2 or 3. And so far, very little progress has been made. The two are significantly different in a number of areas, and both sides firmly believe they are right. So, in my opinion, it is highly unlikely these two will ever completely converge, where we'll get one set of rules for the entire world, but this is where we are for now. So, they basically all break down into a couple of areas though. They have objectives, right? Typically these objectives are to provide useful information. both to investors and creditors as well as other users. We then want to look at our qualitative characteristics. So we want information to be relevant, reliable, and comparable. That's what we saw in the previous slides. We then want to look at the elements. So we want to be able to define the items that the financial statements contain. So through this course, we'll do this. We'll look at things like revenue. We'll look at things like expenses and assets and liabilities and equity. We'll look at all of these different topics, and that is what we're going to have to do to actually have functional information. Finally, we'll look at recognition and measurement. So we'll set the criteria an item must meet for it to be recognized as an element. And then once again, we'll look at how we actually measure that element. So the bulk of this chapter is starting here. This is the most important section of this chapter. So if you're only going to really understand one area, right, this is where you really want to key in on are these next couple of slides where we talk about principles, assumptions, and constraints. Because these types of things are going to tell us everything we do for the next 11 chapters. If you understand this section of chapter 1, the rest of the course becomes much, much easier. So please take the time to actually understand this. So when we talk about accounting principles, we've got 4 main principles. We've got the measurement principle or the cost principle, which tells us that accounting information is based on actual cost because that is tending to be objective. So what was actually paid for something is what we're going to record today. So if I have a piece of land valued at $1 million, but I only pay $850,000 and I receive the land, then it goes on my books at $850,000, not $1 million. Right? That valuation can be inflated, but what I actually paid, we have a record of that. So I know that is objective. We'll then deal with the revenue recognition principle. So here this has 2 pieces. For now, I want you to really focus on point 1 because we won't deal with point 2 until I believe chapter 7. So it'll be quite a while down the line that we'll deal with point 2, but we'll deal with point 1 right away. So point 1 says we recognize revenue when goods or services are provided to the customers and at an amount expected to be received from the customer. So let me ask you, don't you buy tickets, say, to an event ahead of time sometimes? How does that person record the revenue for that, right? You bought a ticket on January 1st for a concert on March the 5th. What happens on January 1st? I don't know. We'll talk about it though, and we'll look at that later in the semester and see how this actually works. But this is the kind of thing we're talking about with the revenue recognition principle. On January the 1st, when they received your cash, they do not have revenue, right? And that is the key point here because they have not yet provided the service. The second point here is at an amount expected to be received. We'll deal with this when we talk about bad debts, and we finally recognize in chapter 7, people may not always pay us. We'll then look at the expense recognition principle or the matching principle. This is where a company records its expenses incurred to generate the revenue that is reported. It doesn't make a tremendous amount of sense to us right now, but as we get into some of our journal entries in a little while, hopefully we will start to see that making more sense. And finally, we have our last principle here, the full disclosure principle, which tells us the company will report the details behind the financial statements. So the idea here is our financial statements are generally only a couple of pages long. We've got 4 main financial statements. In total, they're only going to be a handful of pages, right? 1 to 2 pages a piece typically, right? We try to get it on one. Every now and then one of them will trickle over to a second page. But we try to keep them very concise so that an investor can very quickly look down that 1 or 2 pages of information they want and be able to tell exactly what happened with the company. But within that, we may be leaving out a lot of details. So what we'll find is, yes, we may only have 4 or 5 pages of financial statements at the front, but behind that, we may have reams of paper, right? Hundreds of pages of detailed notes telling us, well, what is included in the cash and other cash accounts line? What is in that, right? How did we get this number? What is in my accounts receivable line? How did we get that number? What assumptions did we use? What rules did we apply? All of that type of information will be found in the notes to the financial statements. Now, we've dealt with our principles. We now want to look at our assumptions. So when we look at our assumptions, we look at what is called the going concern assumption. Going concern assumption is critical because this tells us we assume the company will continue to operate in perpetuity, which allows us to use our typical accounting rules. In the event we believe the company is filing for bankruptcy or going under, then we are no longer able to account under normal circumstances, and we have to shift to what is called the liquidation basis of accounting, which is well beyond the scope of an introductory course. But that is why this is so important. It allows us to apply our basic rules that we're going to learn this semester. So while we're not going to really talk about it much after this point, this will be an underlying assumption in every situation unless I specifically tell you not to assume that the company is okay in the future. Right? If I tell you a company looks like it is closing soon, if a company looks to be going out of business, this would be a violation of which assumption? Then you would say, oh, that's a violation of going concern, because going concern says this company will operate in perpetuity. We've then got the monetary unit assumption, which just tells us transactions are expressed in monetary or money units. So when we are recording journal entries, this tells us we don't need things like dollar signs in there. We know that this is talking about dollars. So if I look at my financial statement and it says cattle, $1 million, right? Or 1 million. That's not telling me I have 1 million units of cattle, right? It's not telling me I have 1 million head of cattle. What it's telling me is the monetary value of that cattle is $1 million. We then got the business entity assumption, which tells us the business is accounted for separately from other business entities, including its owner. So if I own the business, as long as I'm not running essentially a sole proprietorship, me and the business are separate, right? So if I've got a corporation, which is what this course is primarily dealing with, is corporate accounting, Walmart and Walmart's chief shareholder are not the same. So anything the chief shareholder does should not be reflected on Walmart's books unless it was done through the Walmart company. Then it should be done on their books. So one of the most common things that I'll see is in the practice set that I'll have you do, I'll give you a question typically that says something like, the owner of this organization bought an engagement ring for their fiance. Should this be recorded in the business's journal? And the answer is no, right? If you buy jewelry for somebody that you know, that is in no way related to the business. That is your personal activity. So that personal activity should not be reflected in the financial statements of the organization. And we see that coming through because of this business entity assumption. It essentially creates this firewall that cannot be breached between the individual and the organization. And finally, we've got the time period assumption, essentially telling us the company can be divided into time periods, such as months, years, days, weeks, quarters, whatever you want to talk about. But we're going to be keeping our records in a detailed enough manner that we can pull information down into these useful time periods so that we can actually be getting good information out to our investors. Now, several different types of organizations we want to talk about here. So I'm going to go through this fairly quickly. This chart is in your textbook, though. I do recommend you at least be familiar with it. I'm not going to have you quote it, but I certainly do like asking questions on the different characteristics or giving you situations where I lay out a company structure and ask you which type of company I have described or which type of organization. So the first of these is a sole proprietorship. The key word here is sole, one, uno. You have one owner. So this is a sole proprietorship. You decide you are going to go out and start a company by yourself. Pretty easy to set up, all right? No one else has to get on board with this. You simply decide, I'm going to go start a sole proprietorship. The good news here is there's no additional business income tax. This is what we refer to as a pass-through entity. You will pay the tax at the individual level and only at the individual level. The bad side of this, there is owner liability that is what we call unlimited. So because this is unlimited, this means that you and the organization are essentially the same thing. If your company goes bankrupt, guess what? They can come after your personal car, your personal assets. You as an individual are up for grabs essentially because there is no legal entity differentiating you from the business. So sole proprietorship, very easy to set up, no additional business income tax, but incredibly risky because if your company goes under, you are on the hook. Now, luckily for you, there are certain firewalls put up by the government to say, like, we can't kick you out of your primary residence and make you homeless, right? So there are some things that are off limits, but by and large, a lot of your personal assets are up for grabs in a sole proprietorship if you run it into the ground, right? So if you are unsuccessful. Now, in terms of a legal entity, right, there is no legal entity. because you and the business are the same thing in the eyes of the law. Now, the business life here, when you die, so does your business. So it does have a limited life. So it either ends when you decide it ends or when you die. Now, a partnership simply involves at least two people, right? You have to have partners. So you can't be partners with yourself, right? If you only have you have a sole proprietorship. But if you have more than one person, you have what is called a partnership. Now, there are different types of partnerships. There's what's called a general partnership versus a limited partnership. All of that type of stuff I'm going to leave for your business law courses. Okay, that's fine. You do probably need to know that stuff. And here I just need you to know what a partnership is. It's two or more people working together in this organization. Now, the good news here is easy to set up, right? You simply find somebody, you agree, you toss in some money, you're done, right? You've got a partnership. There's no additional business income tax. It's once again a flow-through entity. Typically, you'll receive a K-1 detailing the information about your share of the partnership's activities. This will be generated from either a 1065 or an 1120S, depending on how your partnership is structured. You'll get that at the individual level. These business tax returns that you'll file, either the 1065 or the 1120S, are simply informational returns to the government saying, hey, here's what the business did, no taxes due on them though. You then get your share of that income out on your K-1, which is then what will pass down to your individual 1040, and you will pay the tax on your 1040. So no additional business income tax. You simply pay the tax one time at the individual level. But the bad part here is, once again, unlimited liability. And the real killer here is partners are jointly liable for business debts. So you are super, super responsible. You never take any major risks. You think everything through 1,000 different ways to make sure you are protected. The person you go into business with likes to gamble. They go down to Vegas and they gamble away all of your company's money. You come in the next week trying to write checks to pay your bills, and they all start bouncing. Guess what? You are equally liable. Even though you did not go down to Vegas and lose all the money, and your partner did, because this is a partnership and there's no legal distinction, there's no firewall in the eyes of the law, your personal assets are up for grabs just like theirs. So, what I would tell you is, if you're going into a general partnership, it is like a marriage, right? You want to make sure you understand that person in every way. How do they react when they're mad? Do they go blow off steam by making crazy choices? Do they go waste a lot of money when they get upset about something? When something doesn't go just right, you want to know how they're going to react, because you are putting your personal livelihood in their hands just as much as they are in yours. So you want to make sure you've got a good working relationship before you ever touch a partnership. While they are both risky, right? The sole proprietorship and the partnership, in my opinion, the partnership is so much riskier because you can only control what you do. You have no control over what your partner does. So it's very difficult to go into a general partnership. Now, there are certain organizations that actually market themselves as general partnerships because they say, we are so confident that we aren't going to have any malpractice. We are so confident that all of our employees are going to always do what is right, that we are willing to take this risk, right? That's fine, but oh man, is it a big risk, right? But some companies do use this, or some partnerships rather, do use this as a clever marketing idea. Now, once again, no separate legal entity here, and the business will end either when the partners decide to end it or with the death of a partner. Now, let me ask you, what happens? You and your buddy go into business, right? Tragically, one of you dies in a car accident. There is now one owner of the organization. Do you still have a partnership? Okay. So you had two owners. You went in as a partnership. One of you has now tragically passed away, leaving only one person. You no longer have a partnership. You now have a sole proprietorship. Because you have a sole proprietorship instead of a partnership, you will have to file paperwork with the government. I don't remember exactly how quickly it is, but fairly fast, to tell them that you no longer have this partnership. It has been redone into a sole proprietorship. Next, you look at the corporation, which is what we'll be dealing with primarily in here. Here you have stockholders or shareholders, which own shares of stock. The issue here is you do have an additional corporate income tax. So what happens is the company makes their income, they'll file what is called an 1120C. This 1120C, unlike your 1120S and 1065, is not an informational return. It is actually a tax return with tax due on it. The company will pay taxes at that corporate level. Then, when you actually receive the money paid out in the form of a dividend as the owner, you will pay personal income tax on that dividend, either at your ordinary income tax rate or at 15% currently. All this could change as changes in the tax law occur, but at the time of this video, that is what we see. So you have what's either called a qualified or a non-qualified dividend. In the case of the qualified dividend, you get the lower tax rate, but that is what we see here. So you do see this second layer of tax. The company pays the tax first, there's your first layer, and then the individual pays the tax when they actually receive the cash out in the form of a dividend. So you say, well, why on earth would I want to be a corporation? I'm paying tax twice. I don't like paying tax once. Why would I volunteer for this? So the idea here is this will give you protection in the form of limited liability. This allows our owners, called stockholders, to not be responsible individually for the debts of the corporation. So if the company goes bankrupt, you will lose every penny you have ever invested in this organization. True, right? You will lose everything that you've invested. But guess what? All of your personal assets are safe. It does not matter. You are protected. Now, there are some limited cases which you'll deal with in your business law courses where a legal entity or where, say, the government can actually pierce the veil and come after the individuals behind the corporation, but it's very limited. It very rarely happens. So you do have this very strong firewall of limited liability, meaning that you can't lose your personal assets, which is fantastic. Now, as far as a separate legal entity, yes, you do have a separate legal entity, and the business does not end when you die, right? Typically, corporations have many shareholders. If one shareholder passes away, there may be thousands of other shareholders that essentially continue on. And so we see the life here as indefinite. Now, perhaps the best of these is what is called the limited liability company. One or more individuals are involved, right? Same thing with a corporation. You don't need more than one person. You can incorporate with only one owner, but typically you'll have more than one. The same thing is true with an LLC. You'll have one or more people called members. The good news is there's no additional business income tax. You do still get the limited liability, and you do still have a separate legal entity as well as the indefinite business life. I do believe there are limits on how large an organization can be to become a limited liability company. So that is the issue with, like, why, for example, Walmart isn't an LLC and instead they did choose to incorporate, is because I think they're too large for the LLC rules. But that's what we see. Right in the name of the LLC, of course, is limited liability, indicating that this does give us that protection of limited liability. Now, the next thing we want to look at, let's zoom out a little bit, is this constraint that's going to override everything. So we've got what's called a cost benefit constraint, which tells us we only want to gather the information that gives us more benefit than the cost needed to obtain that information. So this can deal with just gathering information. We can also deal with things like internal controls. Okay. So you say, well, how does this work in regard to internal controls? If it's going to cost me $1 million to effectively control something that only costs $10,000, I probably don't really care about spending that $1 million to save $10,000, because that is a tremendously bad decision. The cost dramatically outweighs the benefit. Even if all $10,000 of that asset walked off, right? I've still got $990,000 that I wouldn't have if I protected that. So this cost benefit constraint is going to be pervasive throughout the organization. Now, there are certain times we have to do things as a matter of law where they say, look, we don't really care if it's costly to you, you have to do this. And so we'll do those things. And then we've got what's called materiality. So the only information that would influence the decisions of a reasonable person will be disclosed. Once again, if Walmart loses $5, most people won't really care about that. Now, most important equation in this course is what's called the accounting equation. It is written in red at the top: assets equals liabilities plus stockholders' equity, or in this case, just equity. If you're only going to know one equation for the entire course, make it this one. This is the most important equation you will see in this course. You will see many, many equations, but this is the overriding one that helps us with many other things. Now you can see this expanded out a couple of different ways. Assets equals liabilities plus contributed capital plus retained earnings is another way to write this. And of course, the last piece here is assets equals liabilities plus common stock minus dividends plus revenues minus expenses. You'll notice revenues minus expenses gives us something called net income, which will be a feature throughout this course. Now, we're going to look at a few transactions here. I'm going to skip over some of these, but we'll go through a couple here just for the sake of time. We're not going to do all of them. So the first year is Chaz Taylor invests $30,000 cash to start a corporation named Fast Forward. So in this case, we invested cash. Remember, in this course, you are the company, you are not the individual. So make sure you understand that as you work through the course. So you are the company received cash, so cash is increasing. When someone invests money in our company in exchange, in this case to start the company or in exchange for stock, then we increase common stock, which is an equity account. If you were to write out this equation, you would see that cash is an asset that is increasing and equity is increasing because common stock is increasing. Notice your total assets then of 30,000 equal your total liabilities and equity of 30,000. So what we're seeing here is, what we are seeing is our assets, what we own, right, is equal to our liabilities, so people we owe money to, plus the money that people have put in. So essentially what we own is equal to how we paid for it. And so that's what we see here. Now, second piece, company purchased supplies paying $2,500 in cash. You'll notice we paid cash. Cash left the business, so cash went down. We have one asset decreasing, but supplies is going up. Supplies is another asset. So what just happened is one asset came down, one asset came up, making this an actual wash and remaining in balance with our overall accounting equation. So you notice here, cash has gone from 30,000 down to 27,500, and supplies have gone from $0 up to $2,500. At this point, though, we now have total assets of $30,000 and total liabilities and equity of $30,000. Notice the form of our assets changed, but the total did not. So cash used to be our only asset. Now we've got less cash, but we also have supplies, which makes this all equal out. Now, transaction 3, we're purchasing equipment for cash. Once again, one asset going up, one asset coming down. Cash is going down, equipment is going up. But you'll notice once again, our total accounting equation remains in balance. Next, we purchase supplies on credit. So what this means is we went into a store, we bought supplies. We did not pay for it today, we will pay for it later. This is what it means to buy on credit. So we receive supplies. Supplies are an asset that are increasing. Accounts payable is how we record a credit purchase. So I owe you money. I recognize that. Because I have to pay you in the future, this is a payable. Most of our liabilities will feature this word, at least a tremendous amount of them early in the course. So when we see the word payable, I want you to think liability. That is a liability. Almost every time. I'm sure there is an exception, but almost every time you see the word payable, that is a liability. So in this case, one asset goes up, and so does accounts payable. In this case, this grosses up our balance sheet. So assets increased by $7,100 because we got more supplies, but notice our liabilities also increased. So what you are noticing is this accounting equation of assets equals liabilities plus equity will hold true forever. If this is ever not in balance, it is because you have made a mistake. This is a fantastic way to check your work as you go, is to make sure your accounting equation is always in balance. Next, we provide services for cash. So we provided consulting services and received cash today. In this case, we received cash. Cash increases, cash is an asset. We receive revenue because we provided the service. At the moment that we provided the service, we have earned the revenue. Revenue is part of equity. So equity is increasing by 4,200 and assets are increasing by 4,200, remaining in balance. Next, we're paying expenses in cash. So we paid $1,000 of rent and $700 of salaries. Cash has gone down for both of these. Rent expense has increased, salaries expense has increased. Because both of those are expenses, they are reducing equity. So you'll see that coming out on the side. So expenses, $1,000 and $700, bringing down our equity, bringing down the right side of our equation to 39,600. But we paid cash for both of those, which also reduced our assets, bringing our asset total down to 39,600. Now, in this case, we provide services for credit. So we provided consulting services of $1,600 and we rented a facility for $300. Well, in this case, the customer owes us $1,900. So what's going to happen here is we would normally debit our cash account, or we would see cash increasing. But notice here, it does not say we received cash. It tells us we provided these services to a customer on credit or for credit, which means they owe us. Okay, so before we owed somebody else, we had what was called a payable. Now they owe us. In this case, we are set to receive cash in the future. So instead of having accounts payable, which is a liability, we have accounts receivable, which is an asset. That accounts receivable account is increasing. We then see consulting revenue, which is an equity account, increasing, and rental revenue, which is also an equity account, increasing, once again, leaving our balances equal. So I'm going to skip through the rest of these as we've gone through quite a few. If you have questions on the others, feel free to reach out to me. I'm happy to discuss them with you, but this video is already getting fairly long, so I want to try to wrap it up for us. You'll notice here in total, all right, we come down, we see our cash of $4,800, our supplies, our equipment, whatever, all that stuff. If we were to actually total all of this out, we would find that our total assets will in fact equal our total liabilities and equity. So adding the 48 and the 96 to 26 will equal out to the 62 plus the 30 minus the 200 plus the 61 minus the 17. Now, a couple of things we need to cover here toward the end are our financial statements. The first of these is what's called the income statement. These are the most important pieces of this course as a whole. Okay, this is the culmination of everything we'll be doing this semester, is preparing these financial statements. So the first here is the income statement. It describes revenues and expenses for typically a year, 1 year, a fiscal year. This can be done for a month, a week, a quarter, whatever, but the most common, of course, is that yearly income statement. After we've done that, we will look at our statement of retained earnings. So on our income statement, we're seeing revenues and expenses coming down to net income. We'll add some other stuff in there in later chapters, but for now, I need you to know revenues and expenses. Statement of retained earnings. Here's where we're going to look. We'll take our beginning retained earnings plus our net income minus any dividends declared will give us our ending retained earnings balance. We'll then prepare our balance sheet using our new ending retained earnings. That will fall in to the equity section of our balance sheet, which is essentially our accounting equation. So our balance sheet shows us that equivalence of assets equaling liabilities and equity. Of course, we'll prepare all of these in class. And finally, the statement of cash flows, which will identify cash inflows and outflows over a period of time. In this chapter, I simply need you to know statement of cash flows includes operating, investing, and financing sections. If you know that, that is plenty for now. We'll deal with the rest of it in chapter 12. So here's where we see our financial statements. Notice we have our income statement. We have our revenues minus our expenses giving us net income. You'll notice how net income is flowing down into our statement of retained earnings. Also pulling out our dividends gives us our ending retained earnings balance. This ending retained earnings balance will then flow through, as we said, to the equity piece of our balance sheet, allowing our total liabilities and equity to balance out. Notice if we had used beginning retained earnings of 0 instead of 4,200, this would have only been 36,200, which would not have been enough to actually balance. You must use this new number for your equity section to balance out and to make your balance sheet actually balance. Remember, it's a balance sheet for a reason. It is not called the unbalanced sheet. Please do not ever turn into me a balance sheet that does not balance. Finally, we see our cash balance coming down into our statement of cash flows. Once again, you will not be preparing the statement of cash flows here in chapter 1. We will simply look at it in chapter 12. Next, we're going to look at our first ratio of the course, which is return on assets, simply taking net income divided by average total assets. In this case, you can see that for Nike in the current year, their return on assets was 19% versus Under Armour of 7.9%. And it looks like Under Armour is getting worse over these last 2 years. So we were at 11.4 down to 9.4 down to 7.9, while it looks like Nike is increasing just a little bit. So It looks like in this case, Nike is being a little bit more efficient year over year, and Under Armour is becoming less efficient year over year in generating that income. Now, that is the end of chapter 1. I'm not going to cover the appendix. So with that, we've officially covered our first chapter in this course. Please let me know if you have any questions. I'm always happy to meet with you either through email or in my office. But that is our first course, so I'll see you again in chapter 2. Thank you.